Have you ever wondered why Bitcoin is not already trading at hundreds of thousands of dollars, and what some people believe could be an invisible force holding it down for months on end? Well, what you are about to hear is one of the most provocative and controversial narratives in crypto today, so stay with me until the very end. Because what we are going to break down could change the way you think about Bitcoin, markets, Wall Street, and macro finance in general. It all starts with a theory that circulates on Twitter and in crypto circles that banks and major financial institutions are intentionally manipulating the Bitcoin price by shorting a company that became synonymous with Bitcoin itself, a company that became the poster child for corporate Bitcoin accumulation called MicroStrategy. And this theory claims that those alleged actions are the reason Bitcoin is not already at 500,000 or more. Now, before we go further, let me make it clear, this is not a definitive accusation, and there is no proven evidence of a coordinated conspiracy. But there are real financial structures, real debt dynamics, and real market incentives at play that could explain a lot of what we are seeing in the market today. So let's unpack the story from the ground up and get a full picture of why this narrative has traction, what it means for Bitcoin, and what the latest news and trends actually suggest about where we are heading. To understand this, we must begin with a concept that sounds strange at first, but becomes terrifyingly logical once you grasp it. A concept called the death spiral, a feedback loop where financial obligations and market dynamics can, under certain conditions, feed on each other and collapse a company or an asset. The idea of a death spiral first emerged in historical contexts, like sovereign debt crises when empires and countries were forced into default, leading to foreign control of their finances. But the same concept can apply to publicly traded companies where debt structures create incentives for prices to fall rather than rise. And the most infamous regulatory review on this was done by the United States Securities and Exchange Commission in the early 2000s when it investigated floorless convertibles, financial instruments that mechanically gave lenders more shares as the stock price fell, creating an incentive to short and push down the share price to get more equity and profit from the decline. This caused hundreds of companies to collapse, and according to the SEC report, nearly 9 out of 10 stocks that used those toxic debt structures suffered negative returns, and nearly half of them were delisted within 12 months. Now the parallel to MicroStrategy, a company whose main function today is essentially buying and holding Bitcoin, is that it is financed by complex debt and preferred equity structures that in some ways create incentives tied to the stock trading at a discount to its Bitcoin holdings, which could theoretically force it to sell Bitcoin to satisfy obligations if certain conditions persist, and that is where the modern death spiral theory is born. Right now, Strategy, previously known as MicroStrategy, holds the largest corporate Bitcoin treasury in the world and currently owns well over 600,000 Bitcoin worth tens of billions of dollars. But despite this massive Bitcoin pile, its stock has been hammered, trading deep below the value of its Bitcoin holdings, which means investors are not willing to pay a premium for the stock, and that is exactly the condition that would cut off Strategy's ability to raise cash cheaply by issuing equity, and could force it to rely on other sources to meet its obligations. Here is where recent events matter, and where real-world developments shake the theory into focus. In the last week, major financial publications reported that Strategy is fighting to avoid what could be described as an $8 billion collapse, as it confronts intense market pressure and a potential NASDAQ index exclusion that could cost billions in passive investment flows if it is removed for having too large a percentage of its assets in Bitcoin and not enough operational business revenue. At the same time, Bitcoin itself recently dipped below $90,000 following renewed volatility in global markets and macroeconomic concerns, showing that even when there is positive news, the market still reacts nervously to broader risk sentiment, something analysts describe as crypto remaining cautious despite other risk assets stabilizing. And this brings us to what is actually happening in the market right now today. Despite all the noise, Bitcoin remains well below its October highs, with recent forecasts from major banks reducing their year-end price targets significantly, poking holes in the narrative that Bitcoin must logically be much higher by now. But before I go deeper into the market context and what it really means, let me ask you to smash the subscribe button and hit the notification bell right now so you never miss a breakdown like this, because the next few months are going to be crucial for Bitcoin's long-term trajectory. Now back to the story. The death spiral theory says that if a company like Strategy is forced to sell Bitcoin because it cannot raise equity at a premium, and if it is burning through cash reserves to pay interest and dividends, then selling Bitcoin into a weak market could push prices down further, which could force further selling, creating a cascading feedback loop that destroys value for both the company and the asset it holds. And that is exactly why some commentators claim that if banks or hedge funds are aggressively shorting Strategy stock, they could in effect be betting not just against a company, but against Bitcoin itself, because a collapsing Strategy could become a macro catalyst for broader Bitcoin weakness. Now again, there is no conclusive proof of a coordinated banking conspiracy, but there are multiple pieces of observable data, short positions, hedge fund strategies, negative research reports, and structural financial incentives that do create real feedback loops in price action, and these are not imaginary. Meanwhile, the regulators are watching and experimenting with new frameworks, such as the United States Commodity Futures Trading Commission pilot program, to test tokenized assets like Bitcoin and other digital assets as collateral in derivatives markets, which could massively influence institutional participation in the years ahead. And this comes at a time when the crypto industry is seeing fresh debates about how companies that hold Bitcoin should be treated by global indices, institutional investors, and fund managers. Debates that, if resolved one way, could easily shift billions of dollars in index flows in or out of crypto treasury firms. So then the question becomes, not just, is there manipulation, but what are the real economic incentives driving market participants? And are those incentives strong enough to suppress Bitcoin prices for months at a time? What we do know from recent reporting is that Strategy continues to accumulate Bitcoin and recently used nearly $1 billion in cash to buy more tokens, a move interpreted by some analysts as a signal of confidence and by others as a hedge against deeper structural stress in the model. At the same time, macro conditions like central bank policy and risk appetite are influencing investor behavior more broadly. And traditional triggers like a Federal Reserve interest rate decision that would normally be bullish for risk assets have produced paradoxical responses in Bitcoin, where market participants interpret uncertainty as a reason to stay cautious. And broader trends in the crypto industry are evolving too, with innovations like proposed crypto index funds and tokenized collateral programs garnering attention as potential next-generation trends for investment flows, possibly shifting how capital enters the space in years ahead. All of this means the simplistic story of banks versus Bitcoin is too narrow. What is really happening is a collision of incentives: those who are long Bitcoin, those who are hedging with complex equity and debt instruments, institutional investors who chase index flows, and regulators trying to build frameworks for a new asset class. So where does that leave Bitcoin itself? Some forecasts now see Bitcoin aiming for much higher levels by 2030, potentially reaching $500,000 over the long term if adoption and institutional inflows resume, while other models envision slower growth dependent on ETF flows and broader macro stability. The bottom line is this: there is no confirmed plot to keep Bitcoin down. There is no smoking gun showing a coordinated bank conspiracy, but there are very real financial structures, market motivations, risk dynamics, and regulatory forces that interact in ways that can and do influence price action. And those forces are shaping Bitcoin's path right now. In the end, what matters most is understanding the incentives, the risks, and the trends that drive markets, and not just repeating narratives without evidence. So as we head into the final weeks of the year with Bitcoin trading in a volatile range and macro uncertainty still high, we are likely to see continued tension between bearish pressure and long-term bullish narratives, and only time will tell which side ultimately drives the next major move. But if there is one thing to take away from all of this, it is that the crypto market does not behave like traditional assets, and neither do the incentives that shape it. So let me know what you think in the comments below. Do you believe there is manipulation behind the scenes? Or is it simply market forces and incentives at work? And as always, thank you for watching, and I hope you have an amazing day. And I will see you in the next video on the Next Gen Mentors channel.